Buy high, sell low is probably one of the most commonly found memes in the retail investing space.
I sold the dip again last night and
But it's got a lot of truth to it, and it's not even funny. We see people buying high and selling low all the time. Don't believe me? Let's look at the stats. Most people have actually underperformed the S&P 500 over the last 20 years, largely due to poorly timed buy and sell decisions. In fact, during the market volatility of 2020-2021, a study showed that 33% of investors sold stocks during that downturn. What happened after that was they missed out on the market recovery, which was significant. In other surveys, we see that investors admit to buying stocks or cryptos at all-time highs only to sell them at a loss when prices drop. Now you might think that this is a trait of a noob investors, but even experienced investors are making the same mistakes. You probably already know why people are buying high and selling low. Emotions, that's the reason. Like most bad decisions in life, it's driven by emotions and not by logic. In this video, let's take a deeper look at why people keep buying high and selling low and what you can do to avoid it. Let's begin. Let's start with a very well-known reason, that is fear and greed. So fear and greed are the two primary emotions that drive markets. In fact, I would say that the whole market is run by fear and greed. These are such an integral part of the investing landscape that there are several indicators that tell you what's happening. The Wall Street cheat sheet does an incredible job of showing how emotions play a role in the market cycles. Fear leads to panic selling during market downturns, causing investors to sell at low prices, and greed causes investors to buy excessively during bull markets, often ignoring fundamentals. One of the best examples of this was in March 2020 when the S&P 500 plunged 34% in just 33 days as fear gripped the market due to the pandemic. I very well remember that people were freaking out back then. Nobody could think of anything good during that time for very good reasons, but the fundamentals of a lot of companies that they were selling out of hadn't changed. The fear was actually mostly driven by the uncertainty that was in the market. On the flip side, once the market had recovered over 2020 and 2021, we saw a massive bull market. During that time, the market went from fear to greed pretty quickly, and there was so much greed in the market that people thought that the market cannot go down ever. Now, I'm not going to sit here and tell you that I was immune to all the greed. Even I got caught up in it, and my investments ended up going down 60 to 70% during the downturn of 2022. But it just goes to show how much greed can take over markets. Greed was also very evident during the GameStop short squeeze in Jan 2021, which was driven by retail investor greed. Do you remember when the stock went up 1500% in just 2 weeks? Those times were quite crazy, and there was no logical or fundamental reason why the stock kept going up. Back then, greed had really taken over the market, and some of my friends were also buying GameStop at its all-time high. I know, it's pretty sad. In fact, one can argue that it's fear and greed alone that leads to bubbles and crashes in the markets. Of course, there's several other sentiments that are part of the market, but mostly they are either on the side of fear or greed. So how can you avoid this though? I'll be the first one to tell you that it's incredibly hard to fight your own emotions, but here are two tips that can help you fight fear and greed. First, develop and stick to a long-term investment plan based on your goals and risk tolerance. Please try to stick to your plan, and if you want to gamble or play around in the market, do it with a separate portfolio, not your main portfolio. Remember, investing is a sport that you should play with the bigger picture in mind. The next one is to practice emotional discipline and avoid making impulsive decisions based on short-term market movements. Here's a simple rule that I follow for my long-term investments. I never buy a company before waiting 2 weeks after finding it. Basically, I wait at least 2 weeks and I do my research during that time. In those 2 weeks, my main goal is to come up with a plan. I don't intend on buying the company immediately. There might be too much greed in the market during that time, and I might need to wait. Talking about waiting actually takes us to the next reason, that is fear of missing out. This is actually something I hear every single day. Do not FOMO. Now, FOMO is something we all come across quite often in life, even in social situations. For example, your friends invite you to a party and you really don't want to go, but you also don't want to miss out, and that's when FOMO kicks in. And the same thing happens in the investing world as well. A lot of people let FOMO kick in when they see a stock going up every single day. Without doing any research, they'll jump into it and throw their money at it. Write this down. Impulsive investment decisions without proper research or consideration of risk will often lead to bad outcomes. FOMO is something we see a lot of in the crypto world because the prices move so fast. Now, I don't have to remind you that during the 2021 crypto bull runs, many investors bought Bitcoin and other cryptos at all-time highs due to FOMO. This kind of FOMO is the worst because prices of cryptos can actually drop 90% multiple times over the bear market. Once the prices have dropped a lot, what? That's when fear kicks in and you end up selling at massive losses. Honestly, social media and the flaunting of wealth that goes around there is creating a massive problem with FOMO. Everybody has started feeling that they urgently need to get rich because they saw some guy posting about it on TikTok or YouTube. Now, you can't even verify that information and it still somehow plays with your emotions. FOMO is probably the most common reason why inexperienced investors lose money. Please don't let that happen to you. First, conduct thorough research on the asset or investment opportunity before making a decision. If you want, adopt my 2-week rule. It works pretty well for me, and it's not financial advice, by the way. The second way is something we have already discussed, that is to set clear investment goals and stick to your strategy. Avoid making impulsive decisions based on short-term market trends. You should also most definitely stop listening to influencers, which brings us to the next reason, that is social media and influencers. In the recent years, social media has been playing a big role in investment decisions for the retail community. It comes with its own pros and cons. The pro is that a lot more people are investing due to social media and the buzz around investing. The con is that it leads to a lot of misinformation, hype, and a lot of crap that flows around in the industry. The biggest problem is actually all the pump and dumps which are being promoted by social media influencers. It's especially common in crypto again. One of the most popular examples of this is probably Wall Street Bets on Reddit. A lot of people are now taking financial advice from just that subreddit. Now, some of those might work out for you, but most likely you're going to be a bag holder, basically losing all your money. Firstly, you should know that none of the people on social media should be giving you advice. That is including me. I'm not here to give you any advice. I just like making videos and talking about finance. While most of these influencers will say this is not financial advice, it ends up being advice for some of the people out there. So if they start promoting bad things are going to happen to a lot of people. I would say one of the biggest examples of this would be the FTX collapse. So many influencers were promoting it on YouTube and different social media platforms, and it ended up wrecking so many people's investments. This is a good reminder that influencers also promote different financial services and products. You should also be cautious about that. Overall, just be cautious of influencers and don't believe them blindly. Do your own research and follow good analysts when you find them. Those are probably the only two ways to avoid falling prey to influencers. Always do your own research on the fundamentals of an investment before making a decision, and definitely be cautious of influencers who promote investments without disclosing their own financial interests or qualifications. I would say the next reason is kind of an extension of what we just discussed, that is mainstream media. Now let me honestly tell you something. My hate for mainstream media has increased so much more since I've been investing on my own. I dislike mainstream media and how they present market news so much that I can even cite it as the #1 reason why people out there are losing money. Firstly, you should always remember that the job of mainstream media is to make money, not to make you money. And the way media outlets are making money is by sensationalizing market news to attract viewers or readers. Here's what they do. When the markets are overinflated, they'll keep bringing on analysts who are very optimistic because they know what people want to hear. They want to hear good news, but often this ends up being very bad for the investors. See, optimism is not bad, but during the wrong time, it can fuel a lot of greed. And this is something we have seen a lot of happening in 2021. Now, on the flip side, during market downturns and especially during market bottoms, you'll see a lot of negative news coming out of media. Again, these are probably the best times you should be buying assets while they are fueling a lot of fear in the market. There's one important lesson I learned from an investor named Adam Khoo. Firstly, please check out his YouTube channel. He makes brilliant content. He shared something a while back which really stuck with me. He called it the sad face indicator. He said media tends to show you a lot of sad faces as the markets are bottoming. Now, of course, don't use this as the only indicator to know where the markets are going, but what he was trying to demonstrate is how the media plays a role in how you invest. Firstly, media will always be biased no matter what you think. They will favor the companies which are probably advertising on their platform. Don't fall for that. Also, you should remember that they always have a vested interest in showing you whatever they are showing you. So how do we escape this media bias? Firstly, I would tell you that stop consuming media and taking your investment decisions. Whenever you are consuming news, make sure you're verifying it later to ensure that you have looked at the right thing. Secondly, again, back to the basics, focus on the long-term fundamentals of a company or asset and your own personal investment goals rather than short-term market noise coming from the media. Now, I'm going to cover the next two reasons together because I believe they go hand in hand. That is always trying to time the market and trying to buy back lower. There are lots of people out there who believe that they can really time the market when it comes to different assets. Firstly, nobody knows what's going to happen on the black side of the chart. There are firms and people out there who have an army of analysts and algorithms behind them. Do you really think you can beat them constantly? Now, there are traders out there who can do it, but most likely if you're watching this video, you are not going to be one of them, at least not for now. This strategy is especially risky if you're trying to apply this to really good companies and assets. If you're buying good companies like Microsoft, Google, and Amazon, it's going to be for the long run. It could be around 5 to 10 years or even more. What's the point of trying to time the market when it comes to these kind of assets, you're better off just buying them constantly over the years. Now, on the far side of this is the second reason that we discussed, that is trying to buy back lower. This basically means that there are people out there who sell all their stocks and try to buy back lower once the prices have dropped even further. The problem with this approach is that it's incredibly hard to time the bottom of the market. Also, during those times, it's very hard to buy assets because fear is in full force. Now, this is a very common phenomenon when it comes to Bitcoin and crypto. There are lots of people who are always trying to time the market. They are selling their assets, buying back lower, trying to buy back lower, but often failing. Yes, that market is very volatile, and that makes it even harder to buy assets. When it comes to this particular topic, I follow two rules. Firstly, try not to time the market when it comes to good investments. Like I discussed, Google, Amazon, Microsoft are some of them. And secondly, it's best to automate some of your investments where you can make regular contributions just to remove the temptation to time the market. This kind of approach is very useful when it comes to ETF investing, such as investing in the S&P 500. Now, I've mentioned the words good companies quite a bit, which brings us to the next reason why people are buying high and selling low. That is not doing your own research on assets and companies. Now, this is bringing a lot of things that we have discussed so far together. There are a lot of people who are buying into assets for the wrong reasons and they have no idea why they own an asset. Now, for example, you go out and buy a stock because you heard about it from a friend. Now, you don't know what the fundamentals are. You just heard that it's a good company and you end up buying it. Now, the prices fall 20% over the next couple of weeks. You have no idea what the next move is. Most likely you're going to sell out of it because you don't know what you're holding. Remember, fear kicks in much harder when you own something that you don't truly understand. This is why it's so important to do your own due diligence when it comes to different assets and stocks. Now, doing your own research is not the easiest, I understand, but at least spend some time learning the basics. Now, some of these include: how do you value a company? What kind of returns are they generating? Are they profitable? What is the general financial health of the company? What are their future growth prospects? You could also look at what some of the good analysts out there are saying about that company. Now, again, I understand it's not the easiest, so consider investing in an analysis tool or rely on some of the free ones out there. Now, what I'm using currently is a tool called Stock Unlock. I'll link it in the description. Those are just some of the reasons that people might be buying high and selling low, but there's one more reason that I wanted to cover as a bonus, that is people keep checking out of the market. This is something I see very often. People get bored of the markets very easily. They get disenchanted with the price movements and then they just leave. They stop checking their portfolio, they stop checking charts, they don't look at any of their investments, and the market keeps doing what it does. Now, this is a great approach depending on who you are and what your investing approach is. But if you're somebody who really wants to understand investing, play the long game, but also diversify into different assets, it's worth staying with the market at all times. Now, I'm not saying that stay with the markets as in look at charts every single hour or even every single day, but at least look at weekly charts and keep track of what's happening with your portfolio. I'm a huge proponent of doing regular reviews of your entire financial portfolio, including your investments. I keep talking about this one-page financial plan that I shared earlier this year. Feel free to check it out. I think I've been shamelessly plugging that quite often. Anyway, some of the other reasons you should stay with the market is to avoid missing out on opportunities for portfolio rebalancing, tax optimization, or adapting to changing market conditions. If you stay with the markets, next time a big opportunity like March 2020 arises, you'll be right there to buy the assets at the right prices. Staying with the markets is what helped me buy Google at 90 and Amazon at 100 a few months ago. These investments have already brought in a lot of gains to my portfolio. Having said all of this, I know there are a lot of people out there who would like to take a more checked out approach to the markets. For them, I have two tips. Firstly, if you want to take a less active approach, consider a passive investing strategy such as investing in broad market index funds or ETFs. They don't need a lot of monitoring and they're self-adjusting, so you really don't have to do anything other than the next step, that is to implement a dollar cost averaging plan to automatically invest a fixed amount at regular intervals. There's a lot of evidence out there that tells us that DCA is the best strategy for an average investor. Even with all the investments I have, I always keep a portion of my money for DCAing into the S&P 500. That's probably the safest part of my portfolio, and I believe that everybody should have something similar at least. So those are all the reasons I wanted to cover today. Please stop buying high and selling low. Remember, if you're buying good assets, you can buy them high, but there'll be an opportunity to sell them even higher. So please stop selling them at lower prices. Now I'm just stating the obvious over and over again. I'll see you next week with a new video. Till then, keep learning and stay on top of your finances. Until next time.